Welcome to Corporate Finance. Welcome to session 11 of Introduction to Corporate Finance on Project Analysis. Once again, we're going to look at major investments and some new concepts like break-even analysis. We'll continue to use our prior analyses that we've brought up, OCF, MPV, IRR, and what other kind of what-if analyses can I do to make sure, once again, I make a good decision on a major capital investment. So our roadmap for our learning objectives are as follows. We want to look at how to evaluate net present value. And again, we're always searching for positive NPV projects. What kind of other analyses can we do? Scenario analysis. How do I know when I'm doing scenario analysis? You'll see words like base case or most likely case, best case, and worst case. That's scenario analysis. And other types of what-if analysis like sensitivity and simulation analysis. A third learning objective, break-even analysis. What are three types of break-even? The one you're most familiar with is called accounting break-even, where EBIT is zero, taxes are zero, and MPAT is zero. This is the one you've learned in high school. This is the one you might have had in college econ class. And no one said it's accounting break-even, but that's what it's known most commonly by. We'll also look at cash break-even and a third one, financial break-even, which you've probably never heard of. So we'll go into those advanced concepts. We'll also look at OCF. Again, from Chapter 2, we had OCF. We're going to have OCF again, EBIT plus D minus T, pointing out that operating cash flow is a very important concept. We'll look at three other ways to calculate OCF, additional to the way we learned in chapter number 2, and if and only if there's no interest expense. So if you have an occasion where there's no interest expense on your income statement, we'll use three other OCF methods that are very simple. Operating leverage has to do with the amount of property, plant, and equipment you have in your business. So if you have a large chemical plant, large paper plant, large water plant, large steel plant with lots of property, plant, and equipment, miles and miles of equipment, we can find it has a high degree of operating leverage. That means it has high fixed cost, and a small increase in quantity can result in is levered up to a huge increase in OCF. And then some final tenets of capital budgeting methods that are used, which methods are most popular out there in the real world. And those are our key learning objectives. There are 6 of them in session number 11. Here are some key formulas for you to know, some 24-karat mnemonic moments of magic. These are a good review from econ class. How do you calculate variable cost? It's simply quantity times variable cost per unit. So recalling some of the things you learned back in basic econ class. Total cost is variable cost plus fixed cost. We'll show you some examples of that. And how do we calculate average cost? That's total cost divided by quantity sold. And then the general break-even equation. Someone took a P&L one day and solved it for quantity. Quantity is fixed cost plus OCF over contribution margin, P minus V. You'll notice the contribution margin is in the denominator of all these equations. P minus V, price minus variable cost, is contribution margin. Very important concept you want to learn. Here's kind of a new break-even. So we've had accounting break-even, which is the one you learned all the way back in high school in an econ class, accounting class. And then we had cash break-even, where OCF is zero. And then now we have a new one called financial break-even. And that's the point at which the quantity that needs to be made and sold to break even, where NPV equals zero. We'll also talk about degree of operating leverage. As I said earlier, that has to do with the amount of property, plant, and equipment you have in your business and the amount of fixed cost you have affiliated with same. When do we get a positive NPV? If you remember that Cottonelle Fresh Roll Wipes example we had in session 10, that was an example of what was supposed to be the most positive NPV project in American history. It turned out to be a complete dud and failure. So when do we get a positive NPV? When we have a project that really has a positive NPV or when we have a project with a positive NPV due to an inaccurate estimate. They had estimated Cottonelle fresh roll wipes would sell like hotcakes in America, and they never took off. That product appeared on the Jay Leno show, the Tonight Show. It was all over the Wall Street Journal. They were supposed to get $150 million in sales in the first year, growing to $600 million in the fifth year. And you can't find one of those devices anywhere these days. So that was an example of a positive NPV popping up because of poor estimates. So we do the best we can to estimate what we think the project will generate, what the cash flows will be on average. We don't expect these cash flows to be exact, but we want to just give it our best guess at the time. So for those Cottonelle fresh roll wipes, as projected by Kleenex, first year sales, $150 million. Year 5 sales, $500 or $600 million. They spent $100 million on R&D, $35 million on advertising, so that a huge advertising budget. Their pricing was at $8.99, and they had 30 patents, so they spent a ton of money on patent issuance, and complete flop. You can't find one of those Cottonelle fresh roll wipes anywhere other than up in my office because I have one. So you get into forecasting risk. Anytime you're doing forecasting, there's a possibility you might have errors in your projections, and your errors will result in inaccurate decisions. So you want to try and minimize forecasting risk or estimation risk. You want to do your best job possible forecasting. It is very important in characterizing and testing market efficiency. But remember this old adage, if you put garbage into your model, into your forecasting model, you're going to get garbage out. So you have to put good inputs. Make sure you have good, solid inputs into your estimates. To guard against forecasting risk, ask a ton of questions. Is our product really that much better than the competition? Will that wet TP really sell like we think it will? Can we manufacture the product at a lower cost? Who is the potential competition? Are there strong competitors? And whenever anyone's pitching you a positive NPV, remember that positive NPVs are very rare in a competitive environment, very difficult to achieve.